Next point, yield spreads. There are a few basic terms you need to learn here. What's a benchmark spread? This is the yield spread over a specific benchmark such as LIBOR or Treasury bond yield. Let's take the Treasury bond yield as an example. If you have a 5-year Treasury bond, and let's say that a 5-year government bond has a yield of 5%, and then you have a corporate bond with the same maturity, same coupon, and that has a yield of 6%. What is the benchmark spread? The benchmark spread here is 1%. It's the difference between these two numbers. This is generally written in basis points, so 1% would be 100 basis points. In my example, I gave a benchmark which is the government bond. The benchmark could also be LIBOR or some other interbank offer rate. So the benchmark spread is almost any benchmark, but the benchmark needs to be specified. As I mentioned, the two popular benchmarks are either a government bond or LIBOR. And the constraint though is that the benchmark yield needs to be less than the yield of the bond or the instrument that you are evaluating, so that the spread is positive. The G spread is a special case of the benchmark spread where you are looking at the yield spread over a government bond. Okay, so this is, as I mentioned, a subset of the benchmark spread. And then you have something called the I spread, which is the yield spread over the standard swap rate. Okay, don't need to get too hung up over here. We'll study swaps in derivatives, but a given 3-year swap, for example, has a fixed rate of 6%. Then the I spread would be the yield spread over 6%. Now, another important point to understand. If I continue with this example, let's say that the benchmark is a government bond. The 5% return on the government bond is considered risk-free. And this risk-free is in quotes because what we are really talking about here is credit risk. Then there is a spread of 1%. That extra 1% that you are getting on the corporate bond is compensating you for some risk that you are taking above the government bond. What are the components of that risk? You might be compensated there for credit risk, which is typically the biggest component. There is also a compensation for liquidity. If the instrument that you are buying is less liquid than the government instrument, you will demand a certain higher return. So that extra return is compensation for liquidity risk. And then there might be some taxation related impact which you are compensated for. The two big ones to keep in mind are credit risk and liquidity risk. All right, next point, Z spread. And I'd encourage you to learn this. A Z spread, which is also called a zero volatility spread, is based on the entire benchmark spot curve. It is the constant spread that is added to each spot rate such that the present value of the cash flows matches the price of the bond. If you are a little puzzled over here, that's okay, because many people get confused about this. I'd say that you memorize the definition and slowly this will sink in. Very simplistically, Z spread is similar to the nominal spread that we just talked about. The big difference is that with the nominal spread, you take the YTM of a bond and subtract the YTM of your benchmark instrument, which is generally a government bond. So notice with nominal spread, you are doing YTM of a given bond minus YTM of another bond. With the Z spread, what you are doing is considering the spot curve. So with the Z spread, you are looking at spot rates. So that is one point to remember. The other point is that it is the constant spread that is added to each spot rate such that the present value of cash flows matches the price of the bond. And let's just illustrate this point. You have a 6% annual coupon corporate bond with 2 years remaining to maturity, and this bond is trading at 100.125. So what does this bond look like? So 2 years to maturity, it's an annual pay bond which makes life easier. 6% coupon, so that means you get 6 and then 106. The 2-year 4% annual pay government benchmark bond is trading at this number, and the 1-year and 2-year government spot rates are given. Okay, so you are given the spot rates. The first question is, calculate the G spread, which is the spread between the yields to maturity on the corporate bond and the government bond having the same maturity. So what is the YTM on the government bond? To do part 1, you need to do 2 things. You need to come up with the YTM on the corporate bond, and you need to come up with the YTM on the government bond. Is this easy to do? So calculating the YTM is easy. I would recommend that you do this using the calculator and not the method used in the curriculum. So the YTM and the corporate bond, N is 2 because we have 2 periods. PV is minus 100.125, that's given. Payment is 6. The future value is 100. You compute the interest rate, that's the YTM, and you get 5.93. And this number is in percent. If you use the same method with the government bond, what do you get? With the government bond, using the same method, but obviously the PV is different and the payment is different, the number that you will get is 3.605%, and the difference between the two is the spread. That spread in basis points is 232.7. So you can get the difference in percentage and then multiply by 100 in order to come up with the spread in basis points. In percentage terms, the difference is 2.327%, which is 232.7 basis points. Now, the next point is demonstrate that the Z spread is 234.22. Generally, the Z spread would be quite close to the nominal spread, which is called the G spread in this context. Now, how do we come up with this Z spread? Remember the definition. It is the constant spread that is added to each spot rate such that the present value of the cash flow matches the price of the bond. So, what is the cash flow? The cash flow at time 1 is 6 and time 2 is 106. What is the spot rate for the 1 year period? That spot rate for the 1 year period is 2.1%. What is the spot rate for the 2 year period? 3.635%. Now, you will generally not be required to calculate the Z spread. You just need to understand what it is. You are told that this is the Z spread, 234.22. In percent terms, what is this? In percent terms, this is 2.34. And here again, 2.34%. What you will notice is, if you take the first payment of 6, discount at this rate, 2.1 plus 2.34, and then you take 106 and discount at this rate, 3.635 plus 2.34. When you discount, you will get two numbers. You add those two numbers. The sum of those two numbers is going to be the price of the corporate bond. That corporate bond, so when you actually do this calculation, you should end up with 100.125. So this should illustrate the concept of the Z spread. It is the equal amount that you are adding to the spot rates such that the present value is equal to the market price of the bond. Say this a few times, look at this example a few times, and hopefully you will understand. All right, next point. An option adjusted spread on a callable bond is the Z spread minus the theoretical value of the embedded call option. So if you think about the Z spread, this is the spread over the benchmark. If the benchmark is the government bond, then what is it that the Z spread is compensating you for? In our last example, it was about 2.34%. You are getting that extra spread for three reasons. One is because of credit risk. The other is liquidity risk. And the third one that we've not explicitly talked about is because of options. For now, we'll ignore taxes, assume that there is no tax impact. But the extra Z spread, or that extra spread, is for these three reasons. If you recall, we talked earlier about callable bonds. When you buy a callable bond, will you demand a higher yield or a higher return? Yes. Now, we touched on this concept of option adjusted price. Now we are looking at option adjusted spread. An option adjusted spread is the Z spread with the impact of the option removed. Okay, so now the point is this. This 2.34 includes the three elements: credit risk, liquidity risk, and a compensation for the embedded call option. If I tell you that the amount related to the call option is 0.34%, in other words, investors are demanding an extra 0.34% because of the call option, what would the option adjusted spread be? The option adjusted spread is the overall Z spread minus the impact of the call option. So the option adjusted spread in my example would then be 2.00, or actually this is the curriculum's example with my enhancement. So the option adjusted spread is 2.00. If we put it in terms of a formula, for a callable bond, the option adjusted spread would be equal to Z spread minus the spread associated with the call option. Okay, so that is the point made over here. Now let's just summarize the main points from this reading. Bond price given a market discount rate. What's the point here? This is the most basic way of valuing a bond. You look at all the cash flows and then discount at YTM. Then we looked at a more sophisticated method, which is theoretically the right thing to do. You can come up with the bond price by looking at each cash flow and then discounting each cash flow at the relevant spot rate. We then looked at the relationship between price, coupon rate, maturity, and YTM. An important point is that if you look at price and YTM, there is an inverse relationship. As interest rates go up, then the price comes down. We also need to understand the concept of interest rate sensitivity to some extent, which we'll also see later, that if you have low coupon payments, then you are getting more money towards the end, and the interest rate sensitivity is high. Also, with high maturity bonds, all else equal, the interest rate sensitivity is higher. Flat price, accrued interest, and full price, this is important. The full price is equal to the flat price plus accrued interest. Matrix pricing, the idea here is that if you are pricing a bond where market values are not available, then you look at other similar bonds and interpolate to come up with the price. When you use that method, it's called matrix pricing. Yield measures for fixed rate bonds, floating rate notes, and money market instruments. So the point here was that with money market instruments, the yield measures are a little non-standard. So what we do is we do annualize with money market instruments, but the annualization happens on a simple interest basis. Also, the periodicity varies, that's not standardized, and we often use a discount basis yield for money market instruments. Spot yield, par, and forward curves. With a spot rate curve, you plot spot rates against maturity. With a yield curve, you plot yield against maturity. With par, you plot yield against maturity, but you assume that the bonds are priced at par. And with forward rate curves, you plot forward rates against maturity. We talked about yield spread measures. So the most basic spread is your nominal spread, which is the YTM on a given bond minus the YTM on a comparable government bond or LIBOR. We also talked about the Z spread. The critical difference between nominal spread and Z spread is that with Z spread, you look at spot rates. And then we talked about option adjusted spread. With option adjusted spread, the concept is that you remove the impact of the option. That's it in terms of this reading. As always, I want you to go over the summary. You should review the learning objectives. I've covered all the examples, but make sure you understand them well. Do the practice problems at the end of this reading, and if you have time, also do practice questions from other sources. That is it.